Greetings, everyone, and welcome to another session with Adroit Financial. And I have to say, my name is Abel Matthew, and I'm really glad to have been joined with Mr. Amit Kumar Gupta of Adroit Financial, Portfolio Manager. Uh, so, to talk a little bit about Amit is one of the best investment advisors and managers out there right now in India and on the small case platform. He is also specially known for his scuttlebutt investing technique and strategy. But today we'll be diving into something very different, and that is about the recovery of the economy. And before we start, Amit, how are you feeling today?
I'm good. Thanks, Abel. I hope everything is good at your end. And thank you for inviting
Yes,
me for this session.
the pleasure is all mine. And Amit, before we start, would you like to introduce yourself with a few words before we go into today's session?
Yeah, sure. I'm part of Adroit Financial. We are a 23-year-old brokerage firm situated out of Bombay and Delhi NCR. And we have been a SEBI registered research analyst since 2016 and a portfolio manager since 2018. And it's been a small journey with the small case, but a very fruitful journey. And I come from a consulting background. Started my career as a consultant and a business analyst. And for the past almost 12, 13 years now, I have been involved with the capital markets and investment advisory and research based on Scuttlebug.
Amazing, amazing. So, Amit, today's session, it is very intriguing and very exciting because we all know that we are going through a very difficult time where everybody is affected, the economy is affected, and maybe we can say that it's a very dark period of time, not just for Indians, for everyone across the globe, for all financial markets in every different aspect. Especially when the pandemic hit, nobody actually saw it coming and things just changed very fast. But why I believe that this session is very exciting or intriguing is because, Amit, when you told that today's session will be about the recovery of the economy. And that is something very exciting for us to hear, for everyone to hear, because it changed the livelihood and it's more of a new horizon that people can look up to when it's talking about the economy and people's livelihoods. So before we dive in, I would like you to, if you have any disclaimers, you can read any disclaimers that you have, and then we can move forward with the first question.
Sure. So just a standard disclaimer before we start the presentation. We are going to discuss some stocks and there may be some stocks in the Q&A as well. So any stock discussed during this presentation is not an investment advice. It's purely done for illustrating our points. And please consider a financial advisor before you actually make any buy or sell decision. And Adroit Financial is SEBI registered RA and a portfolio manager.
Got it. So thanks for that. And so right off the bat, getting into the fun stuff, the first question that I would like to ask is, so today's topic, it's about the recovery of the economy. So my first question would be focused on what makes you think that the economy will recover? What led you to believe in this? And what is the reason why we're having this talk and this session today?
Right. Before we actually discuss, the future, it's always good to go back to the past and see what went wrong. So since global financial crisis 2008, the investment cycle hasn't really picked up. There have been a lot of false starts. But every time we have made some progress, we have seen, one or the other issues coming along, and the progress has been relatively slow as compared to like market expectations. For example, in 2013 we had taper tantrum. In 2016 we had demonetization. Then 2017 we had GST implementation. 2018 we had e-way bills implementation. Then in 2020 we had the COVID crisis. So every time we have, sort of taken baby steps towards reviving the investment cycle, or companies have looked to, sort of do some capex or capacity addition to expand their operations. We had some roadblocks. So I define it as, that investment cycle was like a 400-meter relay race. where we were able to cover the first 100 meters, but at the point of interchange, we were not able to, carry forward the legacy. But now, with the COVID crisis almost behind us, hopefully there is no third wave. And what has happened in the last 18 months or so, we feel that there are multiple drivers now in place for this capex or capacity addition pickup from the corporate cycle. So one of the reasons for that is the tremendous balance sheet strength which is present among the large cap companies. So a lot of these companies, especially in the metals and the commodity space, they have undergone substantial deleveraging in their balance sheets, and obviously they have made profits. But the important thing is that they have reduced debt, or they have actually become debt free. A lot of these companies, so that gives them operation. And now because operations are coming back to the pre-COVID levels also, and the tremendous profit which they have made, they are actually looking for another round of capex or capacity addition. uh, Along with that, what happened with our banking system, where from 2013 till 2016 we had really a lot of history about the NPAs with the banks. uh, Now with the IBC, Indian Bankruptcy Code, coming in, and a lot of these cases like Bhushan Steel and Power, Electro Steel, all these are getting resolved under the IBC, Indian Bankruptcy Code, or the NCLT. Now, not all of the money has come back, but a sort of substantial portion has come back to the banks. So banks have become less stressed. The profitability has increased, and we have seen a falling corporate NPA cycle. So, if you consider both the things together, where the company's balance sheets have become deleveraged and they are looking for capex, and at the same time, banks' balance sheets have also become better, and they can also lend more to these corporates who are looking for the capex or the capacity addition. So both these things are actually happening simultaneously, and that makes us, sort of positive for the coming few years of seeing a good capex pickup. Apart from that, certain sectors like residential, reality sector rather, both residential and commercial, that has seen a slump for close to like now almost 8-9 years since 2012-13. And so a lot of money has got stuck into those projects, both personal money and the government money. Now, with all the new reforms which has happened, in the past 3-4 years, whether it is GST or whether it is VIRA or whether it is launch of REITs and InvITs, etc., we are seeing a lot of demand which is coming back into the real estate sectors, and we are also seeing like financialization of savings into the real estate. So that, coupled with what government is spending, what is the demand globally from the international players, what is happening with China, that gives us sort of a lot of positives of capex being built by these companies. And finally, the PLI incentive schemes, which the production linked incentive schemes, which the government has launched to various corporates, and they have been across sectors, whether it is telecom, whether it is mobile manufacturing, whether it is electronic goods, or food processing. A variety of sectors, have seen the PLI incentive scheme, and that would sort of give sort of preempt, fast track the potential capacity addition of these companies. Obviously we have to see how companies are going to declare the capex in these schemes, but obviously the incentive is there from the government side to build capacity. So these are some of the factors which we think are in place. And when we are creating portfolio for the new portfolio, uh, that's the sort of research and scuttlebutt which we are doing, and which the clues which we are looking at on the ground. So one of the primary, research which almost everybody knows, but that has a very sort of ripple effect, is the corporate tax cuts which happened 2 years ago by Nirmala Sitharaman, our finance minister. So now, because companies have decided whether they wanted to take that option or not of corporate tax cuts. And now they have taken. Now they are looking at building capacity. Obviously, there was a delay because of the COVID crisis, but now a lot of that is translating into capacity additions, because they're looking to spend that money. They have basically done savings from that corporate tax cut, but that money is in the form of cash. So they are looking to spend that money. So when we are meeting the management, when we are researching companies, we are looking, which company is going to spend in the economy. Apart from that, RBI obviously has been accommodative since the COVID crisis started, even a little before that. So they've pumped a lot of liquidity into the financial markets. They've cut interest rates, and if inflation does not go out of hand, then we are going to see lower interest rates for some time to come, at least. So both the corporate tax cuts and the lower interest rates, when combined, this should result into some form of spending by the companies. So we are looking at that. Then if you go sector specific, then a lot of market leaders in cement and steel. So if you take steel, then Jindal Steel, JSW Steel, Tata Steel, they have substantially deleveraged their balance sheets. And similarly in cement, whether you take ACC, Ambuja, Ultratech, etc., they what capex they have done into the past cycle, they're almost like at 75, 80, 85% of capacity utilization. And because the demand is both globally and internationally, it's very robust. They are actually looking to build more factories and build ways to cater to that demand. Obviously, they are also looking for M&As to happen. But that is one point, that a lot of these companies are basically at peak utilization, and they are looking at adding capacity. Then, if we talk about other sectors like refinery capex, the upstream oil companies, or the sugar companies, where they've done capex for ethanol, and the power sector companies where they're doing now renewables based capex addition, or also in the EV space, the kind of capex which is happening now by a lot of unlisted players. So that has been a sort of in an accelerated mode for the past 6 to 18 months. And that is basically reflecting into the industrial intentions. We are seeing in more projects being applied. We are seeing more environmental clearances being happening. And this is across the board, not just like private capex. Obviously, the private capex is more than the PSU capex. But even in the PSU capex, we are seeing a lot of policy push by the government, and a lot of these companies are basically adding into the capex cycle. Obviously, PLI, as I said before, the catalyst is there, but we are keeping a very close track on the companies of how they are going to actually implement this PLI scheme, and how the execution will be there on the ground for these PLI schemes. Because it's a one matter to announce the schemes, and it is a totally another matter to how they are going to execute and get the money from the government, and how smooth is that going to process be. So yeah, these are some of the clues which we are looking at when we are building the portfolio and managing that portfolio.
Got it. Got it. So I think the main idea, or one of the strong points that happen here, is that it's a well-balanced situation for, let's say, two different, that is, these banks, as well as companies that are looking for funds. Both are in a very, a symbiotic relationship where both of them can actually serve each other and serve that purpose at the right time. Am I correct on this?
Yes, absolutely. So I mean, after a very long time, we have a situation where the private players and the government is on the sort of same page as far as the policy push is concerned, and as far as the actual actions which are being taken in the in on the ground.
Got it. Got it. Got it. So this leads me to another question. So like you stated, like, what are the reasons, or why do you think the economy will recover? And it is because of these reasons. But let's dive a little more deeper, and that would be, what are the different factors that actually, led you to believe in this, and what would that be?
Right. So the first factor is that the business registrations are on the rise. So the number of companies which have registered on the last 2 years, despite the fact that we had so many of for these COVID lockdowns and there was a lot of COVID related uncertainty, even if you exclude the LLP companies, which are more like partnership and very privately held companies, the number of companies have gone up by 15% on a 2 year basis. And the last 15 months is really, done very well on that account. The very, positive sense from a portfolio construction point of view is that a very high proportion of these companies are in um, agricultural and manufacturing schemes. So manufacturing, I have touched a little bit before, the various PLI schemes which is happening in auto, contract manufacturing, etc., etc. But I think the agriculture is probably the understated theme here. We had a very strong base of agriculture tech startups which has happened, in the country in the past 2 to 3 years, and obviously it is a slightly underreported in the sense that there are not many listed companies as such. So it's sort of not as much focus for the market participants. But we are seeing a lot of good things happening on that front, whether it is in terms of irrigation, whether in terms of seeds planting, fertilizer planting, just like basic knowledge for farmers being educated how to do the farming, or how to carry out their operations in a much more efficient manner. That business registrations is also on the rise for the agricultural tech startups. At the same time, we have seen the EC grants, the environmental clearances grant, really shooting up in the past couple of years from the government side. So if the companies are firstly, so there are 2 points. One is that companies are applying for the projects, so there is a push from the private capex angle, and second is the government is giving them ECs, environmental clearances, which shows that more capacities can be built faster, and more people can be employed by these, and as a result, the economy, that feeds into the economy, and economic growth can happen at a much faster rate. Uh, so yeah, I mean, so that has been the couple of things. Then we have seen the capacity utilization also going up, improving quite substantially. Obviously, we had the dip during the COVID crisis when the lockdown happened, but now we are back pre-COVID levels. And again, we have seen that the manufacturing orders are also now at the pre-COVID levels. The average order book, which had a dip during the COVID crisis, that is also now back, and that has come back so strong with a V-shaped recovery that now the 2 year CAGR is almost like 12%. And at the same time, we have seen the inventories to sales ratio also falling, which means that the companies are not holding the goods and not storing the goods for the very long time. Basically, they're manufacturing, storing for a brief period of time, and then shipping them out. So that's a precursor for inventory refilling. That refilling is also happening very, very fast at the levels. So these are some of the things. Then the most positive factor, the tax collections which have been done by the government. So if we go back a little bit, and during March, April, May 2020, when the COVID crisis happened, there was a huge question mark about how government is going to fund the fiscal and how government is going to get the money, because there was nothing happening, no growth is happening. I mean, no businesses are happening, everything is shut down. So how they are going to get back the money? But since we opened up, slowly and gradually, we have seen that across the economy, the GST collections have really picked up. In fact, in the last 6 to 8 months, they have been consistently above uh, 1 lakh crores a month, which is still a slightly less than what the government has budgeted for this financial year. But still, the run rate has been at least very consistent and above 1 lakh crores. We had a small dip during the second wave of COVID this year in April, a little bit. But apart from that, the tax revenues are running ahead of the target. And there are other factors also. The capital markets has also been very big contributor to this. We have seen uh, a lot of people coming into the market. Obviously, platforms like Small Case have also grown because so many people are now participating into the capital markets. And what we have seen here is that uh, when more people come into the market, then obviously the tax collections also go up. There is STT, there is long-term, short-term capital gain, there is CTT happening, there is stamp duty happening, and then you had a meteoric rise in the unlisted space, where the startups have got valuations which have been 5x, 10x, 20x also. So again, that has contributed because a lot of people have sold their ESOPs. Again, when you sell ESOPs, that adds to the tax buoyancy as well. So both at the central level and at the state level, we have seen the uh, tax collections go up, and because they have gone up, the capex done from the government side, both at the center and the state level, that has also gone up. So that is, people are at least not worried कि वो पैसा कहाँ से आएगा, पैसा आ रहा है. It's about managing that money and passing it on to the economy for greater benefits.
Got it.
And,
So
yeah,
I just had like one of the questions that I had was so this is basically so far that we're looking, tax and capacity are signifiers that show that this is going to pick up because of the budgeting levels, how it is close to being predicted, and also that the stocks and manufacturing sector is actually refilling on the move.
yes,
Am I correct?
yes.
Or
So basically, government can only pass on, can do more projects if they are getting the money. So ultimately, it's a budgeting call. If they are getting more money from tax collection, then they are going to pass it on to a substantial portion to the not only the welfare schemes, but also into the building of infra and the construction and the highways, etc. And we have seen that in the pick up in the new project announcements, both in the private and the public sector, especially in the manufacturing sectors, where now the announcements have been sort of back to pre-COVID levels. Uh, Obviously, there is a controversial issue in that of the fuel taxation, which has happened now. Both the diesel and petrols are in excess of 100 rupees in most of the major cities. So that is one thing which is sort of a consumer demand dampener. But apart from that, if you look at the other tax collections from a point of view of government, then they are at a pretty buoyant level, and at least that is not a hanging sword on the government, that how we are going to fund a particular welfare scheme or a project.
got it, got it. So so now since that we've had a brief look into what are the signifiers that show why the economy is recovering. So moving on, I think all these two questions, their answers lead to is what are the different sectors where you have particularly seen this change?
Right. The major benefactor for this will be corporate lending. The corporate lenders, the companies which are lending to the big corporates, as they do the capex, these lenders would obviously benefit from higher lending to these big players. But apart from that, we are also very positive on the real estate sector. So, as I talked before, also real estate sector had a bad time. But in the past 2 3 years now, we have started seeing a recovery in the real estate sectors, and the reason for that is the inventory levels have been gone down. Companies have been able to sell their stuck projects, uh, and the new launches have been also gradually ramping up, both in tier 1 and tier 2 cities. So it always helps our real estate balance sheet when housing inventory fails, and the inventory fails for the company, and then the new projects also gets uh, easily sell in the market. So obviously there are, because of COVID, that trend has accelerated, because people are looking at better and bigger homes. They are looking at, like, from graduate from 3 BHK to 4 BHK. A lot of work from home is happening, so people are, who can afford, they are looking at maybe move from metro cities back to tier 1, tier 2 cities. And as a result, we have seen growth in both tier 1 and tier 2. In fact, in the top 7 cities in both tier 1 and tier 2, they have seen a very high number of project launches in the past couple of years. So both sales is happening, inventory is going down. So that is one sector which we are looking to construct the portfolio around. Then there is a export angle, where in the past sort of 15 months or so, we have seen a very good growth in the chemicals and the pharma and the IT in the last 2 years. Obviously, each of them had their own reasons of doing very well, both in terms of market performance and the business performance. So IT, everybody just excel. That trend just of digitization just accelerated in the COVID. Pharma, obviously, because there were so many COVID cases and they had to be treated, etc. Pharma picked up, and then chemicals also picked up because of the China plus one strategy. A lot of capacities in China got shut down, and there was a China plus one strategy where people were looking for alternatives to the Chinese companies. But I think in the coming sort of couple of years, 2 to 3 years, there are new sectors which are getting traction, both from a policy point of view and from a growth point of view. So we have sectors like engineering goods, textiles, electronic sectors, which are on radar for the next couple of years. Most of the engineering good companies, or the capital goods companies, whether it is ABB, Cummins, Siemens, Honeywell, etc., they are doing capex, and they have announced to do a lot of capex within India in the next couple of years. And similar is the case with the textile PLI coming, and the new capacities which are built up. They are also looking at increasing the exports revenue, uh, going forward. So we are seeing good traction into the export segment also, and we are also looking to include that in our portfolio construction. And the third space is the infra. So whether it is construction or infra, we are seeing very good traction, and the activity levels are picking up, over the past couple of years. So we are seeing, like, bank credit to the infrastructure sector going up. We are seeing the registrations of construction equipments going up. So whether you have these big trolleys, tractors, etc., these are going up. Whether you have these GCB, equipments, which are the prices of that is going up. There is definitely a traction which is boosted by what government is pushing by various schemes. Also, there is a bit of a risk from, like, the inflation point of view, because the commodity inflation has really gone through the roof in the last couple of months. So we have to see how the companies are going to finance that, how much they are going to pass it on to the consumer. So the price inflation and how the financing part of the infra companies needs to be washed out. But this point of time, we have sort of moved from first gear to second gear, and the traction in infra activities is sufficient for us to be excited and also include in our model portfolio for the this strategy as well. So yeah.
Got it.
So
So
basically, infra,
this
real estate, construction, merchandise exports. These are some of the sectors which we are looking to include in the along with corporate lenders.
got it. So it's like I don't want to jinx on anything, but it
Hmm.
seems like a lot of factors are coming into play at the right time to create this opportunity where the economy can rise. And that's
Hmm.
like all across the board from manufacture to lenders, infrastructure. Uh, do you think there is any connection why all this is happening at the right time? Or is it?
Huh. So I think as I said right at the beginning, there have been baby steps, but somehow all the things were not coming together. But with this COVID crisis, now we have seen the trends sort of accelerating at the ground. Obviously, it's a case of being pushed to the wall also. Both the government has been pushed to the wall to get the taxations going, and also it has become sort of imperative for the companies also to expand their operations because the demand has been so robust. And
Got it.
since the demand is robust, ultimately companies have to cater to that. That is the only way of expanding your operations and increasing your profitability and increasing your growth prospects. So yeah, I mean, it's a case of everything happening. Hopefully, this will sustain and the momentum sustains in the economy for the next few years.
Got it. So I think demand and supply is the underlying simple principle that has aggravated the whole process.
Yes, yes,
Got
absolutely.
it. Got it. So now this is where the question for the lazy investors like me come in. That is, how do we investors benefit from this?
Right. So for taking advantage of this sort of turnaround in the capex cycle, or pick up in the capex cycle and taking advantage of this investment cycle, we have launched a new portfolio on the small case platform called Economy Recovery Strategy. In short, call it as ER. And so this is more like not a very buy and hold kind of a strategy. This is more like a 1.5 to 3 years kind of a strategy where we'll play the cycle through direct stocks and ETFs. And we are going to basically get out at some point of time in the future. So it's not like a very high churn strategy. The churn will be very low. And because we are going to have a substantial portion, I would say 40 to 50% in the large cap. So for conservative investors, also, it's a much better strategy to have there in their portfolio as style diversification. And so beta will be less than one, impact ratio will be less than one. So, for example, if the strategy does not work out and we have to get out tomorrow, then the impact will be less than 1%. The stocks are chosen according to that. And we have taken care of not just doing the direct stocks, because if there is a theme and I have an ETF for it, then I'll better use that ETF rather than having a 10 stocks in the portfolio. I'll have that. So currently we are limiting ourselves to 20 positions in the portfolio, which will be a combination of direct stocks and ETFs. So, and we are working out the position size as 2.5% each in the multiples of 2.5%. So minimum could be 2.5%, maximum could be 10%. So 2.55, 7.5, 10% in that sense. So the current benchmark is multi-cap because we have some ETFs, we have some large caps. Uh, so yeah, and both options of lump sum and a SIP is available for investing in these portfolios.
Got it. So as viewers, as you heard, you can find this small case in the description box below. please click on the link to find the Economic Recovery Strategy or the ER Strategy Small Case by Adroit Financial. Now, Amit, before we leave today's session, and we've gathered a lot of insight on how the economy is going to move forward. We've seen all the clues to look for. We've seen all the evidence why this has been building up, and we've also seen the different sectors that actually show us proof that the economy is indeed recovering. So we've got a few questions from our viewers who has actually filled in the form, to ask questions. And so I'll start off with the first question. And the first question is from Rahul, who asks, what is Adroit Financial's best investment?
I would not like to discuss stock specific, but I can talk about the few positions where we do not hold it, but we have hold it for a long period of time, and now it's not there in the portfolio. So in the chemical space, we have held SRF for a very, very long period of time, almost for 4.5 years. That has been almost 4x for us. Again, in chemical space, Deepak Nitrate, we recently exited Deepak Nitrate, but that has also been part of our portfolio. Apart from that, there have been a few bets in the pharma space. API, we were present in the DV's lab. We have been present. We are still actually in a couple of portfolios. We still have that. So yeah, these have been there. I would not like to comment on the existing stocks because we are still invested in them. But yeah, these have been a few of the multi-baggers we have created over the past 4-5 years.
That's wonderful. That's really wonderful. So thank you, Rahul, for that question. I hope that answers your question. The next question comes from Jitesh, who asks, what are the sectors we are looking to buy in this portfolio? I think you've already covered that, but since Jitesh is asking.
Yeah, so briefly, it will be a combination of corporate lenders plus infra construction, capital goods, and real estate sectors. A little bit of exporters as well, whether it is engineering goods or textile, etc. So that will constitute the portfolio. Obviously, there are a couple of themes where we feel ETFs can be a better proxy rather than buying 5 or 10 stocks in that. So there are a couple of ETFs currently in the portfolio. So, yeah.
Got it. So thank you, Jitesh, for that question. The next question is from Ankit. How is this portfolio different from the iOS small case? That is the India Opportunities small case.
Right. So for those who are watching this and don't know, we have another portfolio on the small case platform called the Indian Opportunity Strategy, and that consists of majorly mid cap and small cap stocks, which are sort of with the purpose of a wealth generation over a period of 4, 5, or maybe more years, depending on your goals and depending on your risk appetite. And that is a benchmark of a small cap. As compared to this, ER is a more short-term portfolio of 18 to 36 months, which is thematic based. We'll play the cycle and we'll get out if the cycle works out. We can get out early also if the cycle does not work out. But if the cycle works out, then probably 2 to 3 years we are going to stay into that. It will be a low churn portfolio as compared to iOS. In iOS, we have a core and satellite approach. So 40% is around core and 60% is satellite. So we generally don't touch the core portion unless there is a problem in the investment rationale. And we'll churn the 60% of the satellite portion into that portfolio. But here in the economic recovery, we are not going to have that much of churn. So once we've invested and if the company is performing according to the expectations and according to our business rationale, we are going to stay that for a couple of years till the cycle basically turns. So I think from a risk appetite point of view, one can say that iOS will is slightly more risky than economic recovery strategy. From a churn point of view also, economic recovery strategy will have less churn than the iOS. and the investment horizon is obviously a little less in economic recovery, whereas that you can IOS you can hold for much more longer than 3 years.
Got it. Got it. Got it. So, thank you so much for that question, Ankit. So moving on to the next question, that's final question. This question comes from Mr. Dinesh, who asks, what is the time frame horizon of investment in this portfolio, and how investment should be approached, SIP or lump sum?
So investment horizon I've already discussed 18 to 36 months. The minimum investment amount currently is about approximately 45,000 if you buy the whole portfolio in one go. And there are both lump sum and SIP options available. So you can buy, lump sum and then do a SIP based on your cash flows, or like in the current market when we are recording this, there has been a correction of almost 5% at the Nifty level, and stocks have corrected a little bit more. Then you can put in extra SIP to take advantage of that correction also. So yeah, I would say lump sum and then do SIP on sort of anytime market overreacts and corrects. So markets get heated and doesn't correct.
Got it. Got it. So thank you for that question, Dinesh. So I think due to time constraints, I think that's the end of the session today. I really had a lot of fun. It was very informational. It would, hard-hitting facts that prove that, how the economy will recover. And more than ever, it gives us an opportunity to look forward to a brighter horizon. And I think this is one session that has made me really happy in terms of where we are headed in terms of the financial market. So thank you so much, Amit, for joining us today. And before we leave, would you like to have any parting words, share any tips or tricks with our fellow viewers?
Right. So if you have any queries about the portfolio or in general about the markets, I'm happy to receive any queries. You can write to me on my email ID. I'm also available on the couple of social media platforms, Twitter and LinkedIn. You can DM me there for any sort of discussion on the portfolio before you want to purchase that. And yeah, we are launching. We are sort of giving a discount code also till the festive season is on. A 15% discount. I think the details I can share it with Abel and he can put it in the description box. And my final say would be that we believe in the India story. I think this portfolio is more suited of who believes in the India story and who believes that India is going to rise from here, and the good things which has happened in the past 4 or 5 years that has now cumulatively appearing in the economy, and as investors in the stock market, we have to take advantage. We should take advantage of that in the coming time, and this is a good portfolio to have it in your overall asset allocation. And
got it. I think so. Dear viewers, you hear it here. The economy is recovering. Amit has shown us the hard facts, why, the clues, and the evidence to show that the economy is recovering right now. And it has never been a better time for you all to invest. So you can find the Adroit Financial small cases in, especially the economy recovery strategy small case, in the description box below, along with a discount coupon code that is for a limited time period from Adroit Financial. So please check that out as well. And if you have any questions, you can email all your questions to Mr. Amit at amitgupta0310@gmail.com. And at the same time, you can also drop in your questions as comments below this video. So thank you so much all for joining in. Thank you, Amit, for this lovely session that we had shared today. Looking forward to talk more. Thank you and see you soon.
Thank you, Abel, for inviting me, and it's always a pleasure to talk to you. Thank you.
All right. Thank you and have a great day.